Section 11, valuation, P-TECH Course 4, Student Outline, Section 11, Valuation Techniques for Inventory, Learning Objectives. List the techniques the market recognizes for valuing inventory and how to estimate the cost of goods sold and ending inventory. Explain and calculate first in, first out, and last in, first out inventory methodology. Explain the differences between appraisal depreciation and accounting depreciation. Explain the 4 primary methods of accounting depreciation and how to calculate each. Know the differences between acquisition cost and total acquisition cost. Introduction. This section deals with the valuation of inventory. Inventory is accounted for in a variety of ways by businesses. Depending on the nature and quantity of the inventory held for manufacture or sale, the methodology employed may be unique or common to the industry. Appraisers must determine the market value for the inventory that is present or should be present on the appraisal date. Inventory is unique in that it can have a choice of 2 dates upon which to base its value. The importance of good records is discussed throughout this and other property tax courses. The same holds true for the valuation of inventory. B. Value in use versus value in exchange. The concept of value in use versus value in exchange also applies for the valuation of inventory. The amount of the sales price applicable to just the inventory can be determined. The terms and conditions of the sale support the Tax Code Section 1.047 definition of market value. C. Using inventory sales comparison approach to value inventory. Obstacles in adjusting sales for market conditions. The sale of the inventory or business was a result of bankruptcy, going out of business, merger, or other event. The goodwill associated with the name and or other factors related to the business operation cannot be valued separately in most sales transactions. If the appraiser has access to both buyers' and sellers' books, more information can be obtained regarding the allocation of the sales price to the standard categories. If the sale of comparable inventories is deemed representative of the market, appraisers utilize a 4-step approach to value inventory in question. Select sales of comparable inventories. List the sold inventories and subject inventory. Adjust the comparable inventories to the subject inventory, including an adjustment for time. Correlate the adjusted sales price to estimate the value of the subject inventory. D. Using the cost approach to value inventory. Some businesses determine inventory cost using a system that measures the flow of materials in and out of inventory. Here are 6 of the most common methods used. Number 1, specific identification method. Records as the cost of goods sold, the actual cost, and the specific unit sold. Method required when each unit in inventory is unique, but not when the inventory consists of homogeneous products. Number 2, average cost method. A method of valuing all units of the inventory at the same average per unit cost, which is recomputed after every purchase. Example of the average cost method. A business that sells widgets uses the average cost method to estimate its cost of inventory. On December 31st, this company had 10,500 widgets on hand. The following information was obtained from the company's purchase journal. Do you want me to read?
Go.
With the following information from the purchase journal, there's 10 months worth of purchased widgets. That has the date of purchase, the number of purchased, and that is totaled, and then the amount of paid in each purchase. What you're going to do here is you're going to average those to get the average cost of one widget. So the number of purchased widgets over a 10-month period is 159,500, and the amount paid in dollars for the widgets over the 10 months is a total of $55,335. So to get the average cost for the one widget is $55,000 55,335 divided by 159,500 equals the 0.3469 or 35 cents per widget. So the cost of the ending inventory then is that 0.35 times the 10,500 equals 3,675.
That's pretty easy.
Yeah. So now number 3, first in, first out, or FIFO, a method of computing the cost inventory and the cost of goods sold based on the assumption that the first merchandise acquired is the first merchandise sold and that the ending inventory consists of the most recently acquired goods. Number 1, FIFO can be visualized as taking items from the bottom of the stack. Number 2, the lowest cost item is generally a part of the cost of goods sold. And number 3, it is generally regarded as the most conservative method of inventory valuation, as the book inventory value represents the cost of the last items brought into inventory. Example of the FIFO method: a wholesaler of a product buys raw material 4 times a year on the following schedule. There's a date, the number of units, and the price per unit. They have totaled the unit column. The company sells its product on the following schedule: 185 units sold between 4:15 and 7:14, 155 units sold between 7:15 and 9:14, and 90 units sold between 9:15 and 12:31. 430 units sold. There are 240 units left. They will be the ones purchased most recently under this methodology. But guess what? It doesn't really matter when these units were sold. FIFO inventory has a remaining inventory value at 12/31 of $2,735, or $12 times 95 plus $11 times 145. Do you see why?
No, not right off the bat.
Well, since it's first in, first out, the ones of the 240 units that are left, you know that the last ones in, all 95 are still there, and you've got to multiply by 12 to get the amount of whatever that's going to be. And then there's 145 units of the 715 units that were purchased. July 15th. Mm-hmm. So of the 210 minus the 145, well, no, you don't even have to do that. There's 145 left. It's actually 240 minus 95, and then that gives you the 145. And you multiply it by $11. But then you have to add those two values up to get the 2,735.
You're pretty.
I'm helping you.
Yeah. I'm going to have to work that one out. I still don't see it. But
you don't?
I had trouble with this when I was taking the class.
Oh, okay. I can help you with this. This was part of accounting classes.
Oh, it is? Okay.
Yeah. So last in, first out, LIFO, a method of computing the cost of goods sold by use of these prices paid for the most recently acquired units. This differs from the FIFO method in that ending inventory is valued on the basis of the prices paid for the units first acquired. It can be visualized as taking items from the top of the stack. The highest cost items are typically a part of the cost of goods sold. Example of the last in, first out method. Using the same information as the FIFO example, they're doing the same thing. You've got a date column, unit column, price per unit column. Your LIFO inventory has a remaining 12/31 inventory of 240 units, which was figured out above. So to get the value, instead of starting at the bottom and looking, you're going to start at the top. So that 100, your first 100 units counts in your inventory of 240. Multiply that by the $10.50 because you're starting at the top. So then you've got 140 units left. The next 100 will come in from the 3/1 shipment. Multiply that by the $10.50. And then your last 40 units will come out of your 4/15 shipment. And those came in at $10.50. And you add those three amounts up to come up with your 2,520 value in inventory that's left on the shelves.
Those three, $10.50 times 100 plus $10.50 times 100 plus $10.50 times 40.
Yes.
All right.
Now, if it was, that's the LIFO. But if it was FIFO, you would just start at the bottom and do the same thing. So see, you got it. More than you think.
I don't have it.
You have it more than you think.
I don't think so.
No, I think so.
I know how to do the math. It's just getting the numbers that they have there. So.
Yeah. LIFO results in a lower remaining inventory cost than FIFO in periods of rising prices. Appraisers typically add a LIFO reserve to estimate FMV. Fair market. I was going to say full market value. To reduce their tax liabilities, some companies use LIFO for tax and external reporting purposes, but maintain a different cost system for internal purposes. The difference between the two is the LIFO reserve. This allows the company to reduce the internal reporting accounting system to LIFO and gives investors a better idea of how much the company's inventory is worth. The LIFO reserve is a contra inventory account that allows the company to reduce inventory on its balance sheet. For example, if a company had a FIFO inventory of $100,000 at the end of last month and a LIFO inventory of $75,000, the LIFO reserve would be $25,000 because that is what the company would have to reduce the inventory by to reach the LIFO inventory figure. Number 5, gross profit or margin method. A method of estimating the cost of the ending inventory based upon the assumption that the rate of gross profit remains approximately the same each year. Example of the gross profit or gross margin method. Cost of goods sold in the previous accounting period is equal to $201,650. Sale in the previous accounting period is equal to $236,500. Sales in the current accounting period is equal to $110,130. Beginning inventory at cost, $250,000. Purchases this period at cost, $74,300. So the cost of sales ratio is the previous cost divided by the previous sales. So that's $201,650 divided by $236,500, which is equal to 0.8526. And the cost of current sales is $110,130 in sales multiplied by this ratio amount of 0.8526, which is equal to $93,897 cost. So your beginning inventory at cost is $250,000 plus purchases at cost is $74,300, which is given, less the sales at cost, which is $93,897. Ending inventory at cost is $230,403. Number 6, retail method or markup method. A method used in estimating the cost of goods sold and ending inventory. It is similar to the gross profit method. The cost ratio in the retail method is based upon current cost to retail price relationships rather than upon those of the prior year. Example of the retail or markup method. Retail value on January 1, $20,000. Retail markup percentage is equal to 35%. Markup factor is equal to 1 plus 0.35, which is equal to 1.35. Cost of inventory equals $20,000 divided by 1.35 equals $14,814. Remember, the original cost was 100% and the markup is adding percent to it. Markup is equal to 35%. Cost is equal to 100%. Cost plus markup is 135% or 1.35. E. Importance of consistency. Accounting standards call for the use of the same method of inventory pricing from year to year, with full disclosure of the effects of any change in method. This approach is intended to make financial statements comparable. If the firm has audited financial statements, inventory is stated at the lower of the cost or market. A method of inventory pricing in which goods are valued at original cost or replacement cost, which is market, or whichever is lower. If the firm has non-audited financial statements, inventory may remain at cost. The appropriate level of trade must be considered. Owners of inventory at different levels of trade, manufacturer versus retailer, will obviously have a different cost invested in potentially the same items. Historical cost represents the cost without any inflation or deflation considered. Book value is the historical cost less accumulated depreciation. Depreciation is the reduction in the value of an asset from all causes. The appraiser views depreciation as the difference between the replacement cost new and market value. F. Acquisition cost and total acquisition cost. Total acquisition cost represents the total cost of acquiring the asset, including the cost of placing the asset in service. Both freight and installation costs are included in total acquisition costs. Items such as discounts and returns reduce the total acquisition cost. In terms of inventory, total cost refers to any cost required to make the inventory salable. No, it's S-A-L-A-B-L-E.
Oh, salable.
Salable. It feels weird in the mouth. Salable. Generally, acquisition cost by itself does not include freight and installation. The additional cost incurred beyond the acquisition cost to have an asset reach its HBU is an example of value in use versus value in exchange. G. Other terms common in inventory valuation. Shrinkage, loss of inventory resulting from theft, spoilage, or breakage. Write down, a reduction in the carrying value of an asset because it has become obsolete or its usefulness has otherwise been impaired. Inventory adjustments. Inventory markdowns are generally reflective of price markdowns. Estimating inventory obsolescence is an example of an inventory markdown activity. Lost inventory due to theft and or spoilage should be considered. In summary, valuation of inventory is highly reliant on the accounting records of the owner. It is possible to be more reliant on cost information because a prudent business will try to move the inventory as quickly as possible. Idle inventory is not making money. Typically, this means that inventory is not depreciated. However, one must be open to the fact that at times there are items in an inventory that become dated or suffer obsolescence in one form or another and may be worth less than they originally cost. Documentation should be required to make any of these adjustments.